Well, welcome everybody. It's exciting to have Dan here today. Dan is an Owen grad, as you probably saw from his bio, and has had a really interesting career, starting first at Goldman in the private wealth side, and then now in Nasdaq in a really interesting space where, at least my interpretation of it, and he'll correct me on that, is that, of course, they're recruiting listings onto their platform, and so San Francisco is super strategic in that regard to be recruiting listings and have a really cool entrepreneurship center that Nasdaq runs in the city that I've gotten to visit once, and Dan's promised me we're going to host some events there
for free
this year. So look forward to that for sure. But anyways, super excited to have Dan here today. And just start me off. I said 3 words about it, but walk me through your career time here. You were at USC prior to Owen, came to Owen. Tell us about your career arc.
So before jumping into that, thank you all for coming. It's lunch. Appreciate your time. It's great to be back here. I graduated from Owen in 2012. Born and raised in Northern California, small little town called Alamo in the East Bay. Come visit. It's nice. But what was interesting after Owen, I recruited hard into the private wealth management track, went through that with Goldman, spent 5 years in the role in San Francisco. And it was a great experience because I didn't do half as well as I hoped that I would. That was my first foray into entrepreneurship. And for a myriad number of reasons, it was what would you consider a crucible. Prolonged exposure to repeated, I wouldn't say failure necessarily, but repeated learnings about how you could do better, and then having to have the ability to wake up every morning and go back and do it. So that was an interesting aspect, but what I was doing there was managing foundation and family office money, and would generally spend a lot of my time looking at suitability for IPO allocations. And so riffing off that and building a network, which is a theme hopefully you're all working on now, found myself with my future mentor, a guy named Jeff Thomas, who now runs all of Nasdaq's listings, corporate platforms is what we call it, as an EVP at Nasdaq. And he recruited me into Nasdaq to eventually be a managing director of new listings and capital markets. And so just to give a little background there, I am the person that is supposed to convince companies that want to go public on Nasdaq versus the bad guys downtown. And so you would think that that is a pretty cut and dry, rinse, repeat type of discussion, because these are 2 behemoth organizations, New York Stock Exchange and Nasdaq. As much as we'd like to be adaptable and change, much like the ventures that you have going on right now, it's moving the Titanic. So really what it is a huge relationship building exercise that really just in hindsight, I wish I could go back to Owen to do more of the networking, more closing bell, because there's just so much there that factored into what I'm doing now, at least from a structural standpoint. But that's where I've been there about coming up on 7 years. So I manage all IPOs in California, and in 2020, with the beginning of COVID, I went from April telling my wife that we're going to be destitute when COVID started, to the fact that we had 275 IPOs that year alone when the average is 125. It almost killed me. So it was an interesting experience, but it's the best job that I've ever had.
So what's the life cycle of that look like? Yeah. When do you start touching these companies? Yeah. And up to the day of ringing the bell, what does that look like?
So the first thing that you'll definitely be able to tell from me is that I'm not an entrepreneur, right? I work for a big platform, publicly traded company, right? But what's interesting about my role is that I am a participant and observer of founders for at least 3 years prior to them going public. Now, if you put into context of what's been happening since 2020 and the hyperfunding and the growth at all costs and the pendulum shift away from profitability and just so many IPOs, that I've actually had this really interesting vantage point of seeing all of these companies over a 3-year typical sales cycle, they start, you see this evolution going so quickly. You see the founders changing, you see the teams changing because the founders themselves are changing. You see board disputes, you see capital markets issues, with these companies, both private and public, all in this microcosm of just a couple years. And so, but generally speaking, the engagement starts about 3 years, typically around Series B, Series C, depending on which sector. For tech, let's say it's typically around Series C. And then once they have a pivotal funding round, typically $50 million or more, that's when we engage and start talking about what data we can provide their finance team, what marketing assets we could bring to bear to help them achieve greater scale. And then ultimately when they start talking about IPOs, which soup to nuts takes about 12 months, 9 to 12 months, it's where we start placing and helping them find advisors, bankers, auditors, what have you. So then my actual discussion about listing, that's a month and a week, down to the science. The first discussion is just an intro to get to know them, a discovery call, and then it culminates with an hour-long pitch, and then they make a decision. And then after that, we make sure that they have a flawless launch, everyone rings a bell, and just so you know, I mean, we have parties for the companies on the West Coast at 5 a.m. Anyone that wants to talk about which companies that IPO'd from 2020 to 2023 drank the most alcohol at 5:30 in the morning, I am happy to have that discussion because it's breathtaking.
But you have to get used to getting up early.
Yeah.
The life of finance on the West Coast, right?
It's at Goldman, if we asked, was it really necessary for us to be in the office at 6:30 in the morning? And the woman who was a recruiter at the time said, I'm not going to answer that, but just don't do it for a week and tell me how you feel. And it was just so ingrained, and so we're used to it now, but it was a shock.
So tell me one more piece. So we talked about that entrepreneurship center that you guys run.
Yeah.
How does that fit into this, right? Because that's earlier stage stuff, right?
Yeah, you bet. So Nasdaq also has the Nasdaq Foundation. And so for anyone that's focused in any aspect, really quickly, who here is actually going to move and build their own business after grad school? Got one? Okay, cool. Got two? Great. The Nasdaq Entrepreneurial Center, it is a foundation that Nasdaq set up. It's a separate organization. Okay? But what this Entrepreneurial Center does is it serves as an incubator across all sectors. I mean, it definitely has a tech-heavy type of center, and yeah, you will need to probably be geographically somewhere close. You can still be part of the cohort, when you're in Nashville, but what this group does is help engage you with funding sources, with mentors that have been in the industry that you're focused on, those that can help you achieve scale, and then basically set up marketing events where you can actually bring your product to market and start experimenting there. So, again, just so everyone knows, if anyone wants to reach out and have a discussion about that or anything else we talk about today, I am completely open to that. And I would suggest just taking a look. The group that the Entrepreneurial Center does is called the Milestone Makers. And so, they're just a great resource if anyone has any interest.
That's so cool. So I think you've kind of hit on a lot of this, but just one more time, unpack what's a day in your life look like now?
Yeah.
So
one of the things that really just helped was the adherence and kind of focus on routines, and routines that don't involve work. And what I mean by that is, I typically wake up between 4:30 and 5 in the morning. We try to get, some aspect of exercise in. I think a lot of people already do this. But the one thing that's just absolutely I do not do, I don't check my phone for at least the first 2 hours of being awake. I mean, whether that's my personal or my work phone, it's just, it gets everything off on the wrong foot for me. The creativity aspect. There is an element of creativity in my job that I have to think about how to touch people, how to engage. If I'm already just diving into emails that early on, that aspect of it is ripped away right at the start of the day. So, and also I have about an hour-long commute into the city. We go back to the office about 3 to 4 times a week now, I don't read the journal. I don't read CNBC. I purposefully try to read something that takes my mind off of something than what I'm going to be doing for the next 10 hours. And so, we could talk about books, we could talk about podcasts, but the thing is that the most successful people, both founders and people at Nasdaq that I've seen, they're the ones that can walk between both lobes of the brain on a daily basis. And so the only way that I know how to do that is just to focus on the routine to take me out of that mindset before I get into the office. But when I'm at home, what I love to do is just make sure that I have some engagement with my wife and kids. So make them breakfast, help them get ready for school. My wife is a saint. She actually is the one that allowed me even to go to Owen because she basically paid for it all. But she has make sure that the train's running on time, and she's an integral part of that. But I do like to have that in the morning and then in the afternoon. In the day itself, it's really just first and foremost tackling the biggest problem first. I mean, last night on the plane flight over here, there were a couple issues that I was thinking about with work, and those things that keep you up at night, that's just the first thing that you got to tackle, at least for your emotional well-being. Because even if you don't get it resolved, at the very least, you felt like you made some progress. So that's generally what I focus on. And then it's not until about 10 o'clock that I actually start returning emails and doing the minutia, that we often get sucked into doing, because once you do that, you're just sucked in. And so, but come 5:30 or 6, back at home, back with the kids, family with dinner, and making sure to talk to your significant other. You all are going to get super busy. You already are. But just find the time. Just stop and say, you're important, more so than this. And it's going to make your life a whole lot better.
So let's switch topics a little bit. And of course, we've been super fascinated by the Silicon Valley Bank debacle, as it were, right?
Yeah.
What did that look like for you and the folks you work with? Because I'm assuming you guys were right in the middle of all of that. What did that look like?
So first, Nasdaq, Silicon Valley Bank is listed on Nasdaq, or will be formally. What it is today is still a little up in the air. But the Nasdaq Foundation, Silicon Valley Bank was a huge partner in that, from a funding standpoint, from coaching the entrepreneurs. Let's just say that and let's just fast forward to something that is objectively true, when you're changing your risk management to better fit a narrative that you think you're more safe instead of listening to the data, you're in trouble. And that's what happened here. And so with the companies that we ultimately would work with that used and worked with Silicon Valley Bank, a lot of it was a typhoid Mary type of situation. Some were very honest about their exposure, and there was a ton of exposure. And it was a multiplier effect. They could no longer get venture debt. Some couldn't get venture funding. Most couldn't even access their funds. And they had the payroll issues that we've all read about. But on top of that, that was also a knock-on effect for venture capitalists that leading up to that point, they weren't necessarily chomping at the bit to fund in the same levels that they were in previous years. So there's still an element here that we haven't seen play out. But what I've also found very interesting is that there is an element of not being honest with oneself when you run a business. And there's a lot of reasons for that, emotional, objective fact, whatever the case may be. But ironically enough, that Friday when SVB was taken over by the FDIC, I was on the road meeting with 5 companies, literally in Silicon Valley, face-to-face, CEOs and CFOs, on that Monday. I met with 5. I asked every single one of them, in a delicate way, but how are you guys doing? Are you exposed? It seems like you're breathing and alive. How are you doing? Every single one of them unequivocally said, we were not exposed. We were diversified out. Now, let's just think about that for a minute. A $40 billion bank focused primarily in tech, in one of the tech richest environments in the world, a microcosm of 5, that's not a huge sample size, but these are companies worth at least $1.5 billion and above pre-money. They're telling me that they have no exposure. Of course, there's going to be a lot of element that they just want to protect their brand, and I understand that, but it also speaks to, sometimes when things go badly, what exacerbates it is the inability to look at what exactly is happening right in front of you and really embrace it. Because the other half of my clients, ones that I did Zoom calls with, it was like sitting on the having them lay down on a couch. Like I was Freud, and they were just talking about what was ailing them. And so they were honest. And so I guarantee you that demographic will perform better in this uncertain environment than those 5 companies that I talked about.
Which they did ultimately have exposure to, is
Oh,
what you're saying.
no, there's no doubt, because SVB has 85% market share for either your deposits, your venture funding, and some of your corporate funding in California, mostly in Silicon Valley. To go in a 72-hour period and diversify out all of your lending and cash ops to a JP Morgan, which, by the way, if anyone's worked at a big bank before, or even done business with a big bank, everything takes forever. There are competing systems that actually prohibit clients from actually getting onboarded, right? There is no way in 72 hours they could be diversified out and de-risked. That just didn't happen. And so ultimately, yeah, you're right. They did have exposure. They just weren't really accepting it as much as they otherwise would have.
What's your sense of the long-term impact or medium-term impact in the Bay Area?
There's an element that's too hard to tell, but there's 2 undercurrents here that I think venture capitalists need to address. I don't think they necessarily need to answer to this, but they need to talk about it. Because when you have, Founders Fund, for example, that's one of the first pivotal moments on that Wednesday of that week, tweeting out, we are advising all of our portfolio companies to rip their money away from Silicon Valley Bank. And then you have Gary Tan going out and doing the same thing. And then that exacerbates and becomes a viral bank run, which we've all read about. But I don't have that weight. Nasdaq doesn't have that weight to kind of drive that virality. VCs, on the other hand, they absolutely do. And that, by the way, is not a surprise to them. They knew that they had that platform. So one thing that they're going to have to calibrate to, it's there will be another cyclical crisis. There's no doubt. Maybe it'll be banking, maybe it'll be something else. But do they make the problem worse by going into that Twitter feed? How do they communicate now? How do they keep it contained? They will need to think about that in order to save their portfolio companies, because they were ultimately cutting off their nose to spite their face. I don't think they figured that out yet. I think from a knock-on effect, I think it's interesting. The FDIC posted the emergency Fed drawdown for local banks, regional banks. They returned $11 billion in capital in the last week. That's a huge amount. That just speaks to that that regional banks are safe right now. And I think they'll remain safe, but you're never going to have a concentrated SVB ever again, which is interesting. But I don't think necessarily there's going to be a huge impact on the economy, and that's primarily because, and I'm sure we'll talk about this later, venture capitalists are sitting on so much money, and they have to deploy it. They're raising flagship funds right now that, and they haven't even gotten through the principal of their previous flagship fund, and they need to show return. So there will be venture capitalists that fill in the void for the funding purposes. The question then becomes, what are the companies that do receive that, and to what scale? So, what I'm thinking about that.
Yeah. So let's just pivot just a little bit from that, but in that vein, thinking about many of the folks in this room who are interested in financial services and thinking about what the market's going to look like over the next 6, 9,
Yeah.
12 months, we've kind of been in a slow IPO period.
Yeah.
Where does Nasdaq see that headed? Where do you see that headed over the next 6, 9 months?
Yeah. So if you ask not just Nasdaq, but also bankers in general, we would generally all coalesce around the idea of a Q1, Q2 window opening for IPOs in next year. That's revised beyond what we thought was going to happen in Q4 of this year. I don't think that there's going to be IPOs of a material number this year. But what I'd also encourage everyone to kind of think about is not looking at the economy like it's 2023, but looking at it circa 2010, 2012. And if you go back and take a look, there's an interesting aspect of staying private for longer, but the M&A environment for small companies to mid-size to growth stage, that M&A environment was vibrant. Right? There is still, from an entrepreneur exit and liquidity perspective, it's not doom and gloom. Right? If you have a good idea and you've saturated the market with it, you've shown scale, they will take you up. From the standpoint of funding, again, like Axios just put out an article yesterday that said, funding is down 60% year over year. That's a lot, especially when you strip out Stripe and OpenAI. But the amount of dry powder that they have is still at all-time highs. And if you take a look at basically the fund kind of vintages, typically you have ranges, but let's say 3 to 7 years, where you have to close up that fund, start showing returns. I wouldn't say the vast majority, but 60 to 70% are kind of on that 5 to 7 year trajectory. What that means to say is that next year, assuming the IPO window comes up, you're going to also have a simultaneous need for venture capitalists to deploy that cash, right? So then all of a sudden, our reality looks a little bit more similar to 2021, which, could be great, but we also saw that there was a big washout of a lot of companies just because of growth at all costs. So, everything is moving very quickly. Yeah.
But to your point, are you arguing that there is this pent up kind of?
Yep. So just for data's sake, so Nasdaq, I think nationally across all of the states has about 200 companies, either privately or publicly, on file. And the duration of time that it takes to be on file to go public, the duration of time that they have been is typically now coming up 9 to 12 months. Each month it costs $50,000, basically, for these companies to keep these filings fresh. It's not a ton of money, I get it, but compound that over time. They have that much confidence in their business to keep the filings going. They're paying this much money. They are pot committed. It's a sunk cost, you would think, but the fact is that they're not viewing it that way. And so yes, there's a huge pent up appetite for IPOs. There's the pent up capital that still has to be deployed, and there's even more money going into venture now. It hasn't really been deterred, even with interest rates rising, with now other options of investment and return. So yeah, there's going to be quite, when it all comes together, it's going to be quite big and probably very beneficial to a lot of the people in this room.
That's great. Yeah. I like some optimism here.
That's
good. That's good. Well, I'll ask one more, and then I'm turning it to these guys. As you think about companies in a growth stage that are dreaming about an IPO, what advice do you give to them?
Remember that funding sources are transient, relationships are permanent. Right? I think a good example is Thomas Tungaz, who was a general partner at Redpoint Ventures for many years. Just last week, he started up Theory Ventures. He's bringing all those relationships over. He's going to fund those guys. So when you're in your networks, be a connector. It'll help those around you. You'll feel better about yourself, but it'll also expose you to more opportunities, whether that is funding or new businesses or whatnot. Expose yourself to as many people as possible, but do it with intention. So just going back to thinking about the funding atmosphere, if anyone wants to go out and get funding, I think you can actually pull this from Walker, but take a look at the fund vintages, right, before you start mapping out who you're going to pitch and when. Be intentional about that. That's another aspect. I think from a culture standpoint, and we've seen this kind of bubble up recently, it's fine. Be hard driving with yourself and your team. Be merciless, but don't be cruel. I think that there's an element here where you talk about like Frank Slootman, the CEO of Snowflake. No one will argue that he is a fuzzy, warm, loving individual. But he's a fair person that tells his team what they expect, and he drives them really hard. If they don't achieve, then they're out. Okay. But he makes the rules of the game known. So when you're scaling, just remember that the smallest thing as a leader that you do, and I've seen this manifest with teams, it'll have a ripple effect on however many lives you employ. So if you're going to drive, you're going to work hard, that's cool. But just don't be cruel about it. That's really cool. Yeah.
Well, questions from you all? Oh man, Professor Fro.
So the U.S. has about twice as many unicorns as China, which has about twice as many as the EU, and all those economies are about the same order of magnitude. And it gives me perspective on why there's so much, it's one measure.
Yep. Well, I think, the disparity is just moving down. I wouldn't say moving down the value chain as though China or European startups are less valuable or important than American startups. What I mean is that, for example, Sequoia started here, focused here. Then they set up Sequoia China, which is a ginormous operation that I think is a separate legal entity at this stage. It is so massive to that economy. And they haven't necessarily done the same with the EU. Now the EU, with Brexit and other aspects from a legality standpoint, there are obstacles, in forming ventures as we do in the States or China does. But I also think that you'll see the levels diminish in China just because we don't know how their crackdown on tech is really going to reverberate over time. But I think just generally speaking, investors here formed a thesis on China before anywhere else in the world and had the capital to actualize it. And so I think that we are the initial driver. But then when you look at Alibaba or any of the other mainstays in tech in China, they're now perpetuating their own ecosystem that, let's just say if they didn't have the tech disruption, given what we've recently gone through, I think the numbers would be a little bit more closer to par. It'd probably take a little bit more time, but the initial thoughts on that. Right. No, certainly. But I wouldn't, 2022 and into 23, with the amount of IPOs that we had, and then the amount of issues with those companies that went public, as maybe fundamentally not necessarily being ready, we don't necessarily know how that's going to play out as well. Is it going to be a stay private for longer type situation? Does that seize up venture capital funding? There's arguments for both sides. So I guess what I'm saying is that 2022 and 23, these are pivotal years that I do think, in the long and short term, really change things in ways that we don't really understand quite yet.
Questions? Yeah.
Look, a rising interest rate environment for fintech has been great. because they were able to be more nimble, more adaptable to everything changing. Because part of the reason why SVB initially had its issues was because they weren't, when the Fed funds rate went up, they didn't change their deposit rate because that would have been a double whammy for them. While at the same time, you have fintech companies that were offering deposit rates 2, 3, 4 times that size. I haven't seen a change in venture capital appetite quite yet. I still think it's early days. I think it certainly could happen. But I think it's right now what's important is how those fintech players, whether it's, let's say, from one side of the spectrum, which is Acorns to Brex, how they actualize it and keep momentum will signal to investors like, okay, this is where it's at. Because if they can be that much more adaptable for the changing interest rates in a negative environment, which we're in right now, they could certainly be more adaptable in a better environment, right? And so I think you're spot on. Just waiting 6, 12 months, I think it's going to play out really interestingly.
Yeah.
Yeah. Well, at first I needed to just go and ask Google, what is a SPAC? But initially, and just for everyone, I'm sure you all know, but the SPAC stands for Special Purpose Acquisition Company. They form a public entity, they reverse merge into a private company, that private company then becomes public. Initially, it was quicker, more cheap to go public. The investors stayed invested, and everyone was more or less happy. They effectively got an IPO on the cheap. Not necessarily that they weren't ready, but just more so from a cash perspective. The problem with that is that what is interesting is that the initial investment by institutional investors into SPACs, their investment into SPACs and then the business combination was actually a synthetic money market, a fund, where they could take, you get 1 share of common, 1 warrant, maybe a unit, but altogether, if you sell the common share but keep the warrant, then your net return after that holding period, you can synthesize it to create a money market account. And in a situation where real interest rates were negative, that was hugely valuable. Once you have a rising interest rate environment, you don't necessarily need that anymore. But if you're already invested as an institutional investor, why not keep the warrant? And your money's already there, sell the common. So what you're seeing right now are all of these SPACs that de-SPAC, in other words, turn that private company into public. That first day, they're supposed to be trading at $10. That's the baseline. If you're healthy, you're trading $10 or above. I haven't seen a SPAC. Maybe I saw a SPAC just recently that traded above 8. So institutional investors, they're pretty much not into the vehicle anymore, and it's also now more expensive from the standpoint of IPO. It will always be a part of the capital markets. For SPAC, that was done, I think, was 2002. So, but to the degree that we recently saw, I don't know, but I'm not necessarily saying if you ever get to the point where you're being approached by a SPAC, please do. Talk to them. It's still, if anyone's familiar with the theory of dual track process, speaking to IPO bankers, speaking to M&A suitors, speaking to a SPAC, a tri-track process, I guess. But all of that interplay will help your business fetch a higher valuation, in theory. So I'm not necessarily saying it's bad, I just don't think it's going to be as important or fruitful moving forward.
Did you kind of hinted at this, but then stepped away from it. Did you see, or did you believe that there were firms that IPO'd through SPAC that weren't ready, that should have waited? They took the shortcut and ultimately weren't quite there yet?
You do see, you see that happening. And it's not so much in the financial performance or perhaps even the initial fit of product to market. You see it in other things like governance. Having a fully formed board that is looking out for your best interests, having a cap table of public market investors instead of, let's say, hedge funds. There's a reason why IPOs take longer and cost as much as they do, because the amount of aftermarket support you get is far and away much higher than what you get on SPAC. So yeah, I mean, it's tough because also we have, through the end of Q2, there are going to be 200 or so SPACs that need to find an acquisition target or they have to dissolve. Okay? They'll go through an extension, meaning that the sponsor has to give millions of dollars away in a penalty. Okay? Then they dissolve, which is cost, opportunity cost of capital, but also that's from a qualitative standpoint bad for their brand. Like there is a lot of emotional resonance built into finding a target right now, and that is also not necessarily a recipe for success. I mean, there have been headlines just this past week of SPACs focused in consumer goods taking out biotech companies. Like that's not normal, right?
Dry powder on steroids.
Yeah, I mean, so it's a tough situation, but this is just what the market's doing. It's just flushing things through the channels to get to a better equilibrium.
Yeah.
Yeah. Oh, that's such a good question. I wish, if you find the answer out, will you let me know? I'll tell you, and that Nasdaq, so in the early days of ChatGPT, we read about it, started messing around with it, like this is awesome, let's do this. And then one day we come to the office, it is completely shut down. So what's interesting about natural language AI is that in order for it to learn, it needs to be able to be accessible and output out to many, many channels, right? It needs to learn from higher volume, right? The only real way of doing that is having a public aspect to your server. So when you go on ChatGPT and you're wondering how to cheat on Professor Frobe's next test, he could technically, if he had the desire, go into that server and rip out what your particular ISP asked. That's the reason why Nasdaq shut it down. No one would ever put our source code on there, but think if they did. So that's an issue that needs to be resolved, right? And I don't think you can really have an industry built around that in earnest until you resolve that. Because there's just so much valuable stuff that human beings will just want to put in that platform. And so, but it ultimately will happen. Do I think it's going to take the jobs of your loved ones or the people in this room? No. I think it's just taking human capital and moving it to a higher state of return and promise and evolution, in the sense that, like you have with robotic process, iteration, basically RPIs, that create bots that do repetitive, cycles of a task over and over and over. Now that person that would normally process accounts payable can move into a different area in FP&A or strategy and really expand. That's the point. I think ChatGPT will follow that. But yeah, your point's well taken in the sense that the funding that's going to happen in the next 4 or 5 years will be either directly natural language AI or at the periphery. I think more so at the periphery to try to solve the problem of that public nature that we just discussed. But that's going to be a big driver.
So you heard it here first. I think a bird told me that Professor Phoebe has already fed ChatGPT his textbook.
And that's right.
There you go. In the back.
Oh, sure. Well, the interesting thing about Nasdaq is that our revenue mix, we're actually, a SaaS-based company. There's three primary divisions: anti-money laundering, which is a software. Then we actually sell software to other exchanges so that they can run their exchange. So in other words, so the Hong Kong Stock Exchange, we sold them software so they can run their exchange. That's Nasdaq, effectively. And then we have corporate platforms, which we are the largest provider of investor relations, governance, and ESG software and advisory services to public and private companies in the world. So our revenue has been less dependent on listings over time. But what's interesting is that you can sometimes view listings as a loss leader. Okay, our fees are monitored by the SEC. We can't increase the fees, change them, or even offer discounts unless we go through a lengthy comment period with the SEC. So we have really no pricing power. And what we offer as a price, New York Stock Exchange generally does. But what we do is that we bring it through, once we get a listing, we bring them through the product pipeline. They get those investor relations services for free for 3 years. And then we bring them the ESG solutions and then the governance solutions. So in terms of being viable, we're trying to diversify out necessarily of being a strict exchange game and find ourselves moving in the direction of what we think are mega trends. Anti-money laundering, you see that in traditional finance as well as digital finance, especially with FTX and the like. Okay. Then there's also ESG. We are eventually going to get back to a globalized economy. If we want to do business, or your company wants to do business with Europe, at a certain point, when you want to sell something to them, they will ask you, how does your business align with the Paris Climate Accords? If you do not have a quantifiable answer to that question, they will not buy from you. Okay, so you need eventually these services or this type of advisory to help you with that. And then governance, strangely enough, the majority of public company board discussions and votes happened over Hotmail and Yahoo personal emails. Think about how porous and how bad of a security liability that is with some of the most sensitive IP in the world. So we also think that that's an incredible place to drive value. So it's a great question, but we're just moving into a different type of model.
Nathan, we'll get them.
Yeah. So speaking on the IPO and also ChatGPT, I just actually asked ChatGPT a question while we were sitting here because I've heard, at least significantly, that more and more companies are waiting to IPO or not IPOing a lot more than they did back in the 90s because of intense regulation that has come with being a public company. Just in the 90s alone, there were 4,107 IPOs. Now there's been, I guess, 2010 to 2020, there were 2,487.
Yeah.
I'm just wondering, does Nasdaq have a stance on perhaps making it easier for not only companies to get funding through the public markets, but also the flip side, the investors being able to invest in these early stage companies? Because we're getting priced out by a lot of the private equity funds now that, as you mentioned, have a lot of dry.
Yeah. No, that's a great question. And let's also say that the first job they're going to get rid of because of ChatGPT is mine. So thank you for pointing that out. No, but I think if we just overlay those absolutely correct, I'm assuming, data points that you put out there. You also had in that late 90s, early 2000s, you had the implementation of Sarbanes-Oxley, right? And then you also have the SEC coming out and doing a climate protocol for greenhouse gas emissions that will probably roll out in 2024. Around the same time, the SEC is also mandating that board members have to attest that they understand the cybersecurity tech stack that their company utilizes, right? So do I think we're going in the direction of less regulation? Not right now. Jay Clayton, the former SEC chairman, I wouldn't say he was a deregulator per se, but he wanted to make the capital markets more accessible, right? So to that end, I don't think we're ever going to hit the same numbers as the late 90s and the two time periods that you set up. I don't think so. But you will have different SEC regimes that at the margin make it more accessible for certain companies that reach certain milestones. Right? The only reason why Facebook went public back in the day is because they had so many investors, had over 1,000, and they were regulatorily forced to go public. Right? Now that's changed. Will you have companies stay private for longer? I mean, you had a big stint of that happening post-2008, right? And yeah, that built up for, one would argue like 12 years, maybe a decade. And that kind of is what unleashed the big IPO glut that we recently had. So if that's the kind of cyclicality that we would expect, then that's feasible. But at the end of the day, IPOs are going to remain, in my view, a mainstay because I think the market generally pushes towards more optionality in terms of liquidity. That's the reason why we see SPACs nowadays. That's the reason why we have M&A. That's the reason why we have IPOs. So I think it's always going to be there. It's just the proportion will always be calibrated. In terms of getting priced out, what's interesting is that right now there is a large industry developing and has been going on for some time in terms of companies offering either retail investors or quasi-retail investors allocations of secondary shareholding positions in private companies of late stage. Right? So that's one method that you can access through Carta, CartaX, Nasdaq Private Market is another good example, although that's more institutional. But the market is finding ways getting around that. I mean, Robinhood, even if you take Robinhood, for example, I mean, they were actually taking IPO allocations and giving it to a preferred list of users on their platform that they chose by lottery. And that was good business for them, right? So I think the market's going to try to find ways, but I mean, is it ever going to be as easy as going into E-Trade and getting that, that IPO price that all of the big boys got? Generally not. But I do think we're also trying to work hard to make micro-cap companies more feasible, which is another element of looking at risk. Instead of catching a high-flying company at IPO, maybe there was a company that went public at a smaller stage. They're a lot more cheap, both relatively speaking and nominally. We're trying to make it easier for them to exist, to have more institutional investor engagement. So, but yeah, that's a great question. Thank you, ChatGPT. Yeah.
Real quick, coming back to tech and Silicon Valley.
Yeah.
In that regard, it seems like for a long time there was a lot of stint of pushing financing IPOs and not really caring about profitability.
Yeah.
It seems like some investors are starting to change their stance and look a little bit more towards moving to some kind of profitability.
You bet.
So how's that kind of playing out from what you're seeing and your perspective?
Yeah, so you're absolutely right. Let me just really quickly say for all the budding entrepreneurs in the room, in your seed A and B, let's say tech or a derivative thereof, you always need to scale. Okay, your first job at the beginning of the day is to scale. Right? Operational excellence will come in later stages. Finding profitability will come in later stages. Don't let the press tell you that scale is bad. It's bad at certain points. But that's a great question because I can tell you that when we started seeing the slowdown of IPOs in November 2021, it was for no other reason. I mean, ostensibly it was because the Russia conflict with Ukraine had reached a new level of engagement that was on the headlines that gave people risk. But really, a headline underneath that was the pervading need for investors to see profitability. The pendulum had swung. And so that's the reason why we have 200 companies on file, because they had to calibrate to that to show investors that, yes, I might have $500 million of annual recurring revenue, but I'm at break even in 3 months, and let me show you, the pathway there. And if they couldn't do it, then they weren't going public. And what's crazy also is that if you take a look at biotech, keep in mind biotech, you find a molecule in the back in the day, you find a molecule, You prove the science has legs to stand on, you go through a trial or two, you go public. Now, everyone, investors in the biotech field, it has gotten so much swung to the profitability side. They're going to biotechs and saying, look, we're not going to hold you to this, but what is your commercialization plan? You know, to a company that's preclinical. That used to never happen, right? And so I guess to your point, an unintended knock question is that it's swinging way over here. You know, it's going to revert to some sort of mean soon, right? And just to keep in mind, the longest drought in IPOs on a relative basis happened 2 times, you know, after the first tech bubble burst, and then after 2008. 30 months was the max period, right? We are coming into month 20 or so, right? So look, we could deviate from that, but and that's not from me. I mean, Goldman Sachs put out that note. I mean, I like their stuff. And so I guess my point is we're at an inflection point, whether or not we care to admit it or not. That's just a really good question to point that out.
Awesome. Yeah, Alex.
I actually got a question on the credit space. So
Sure.
You're very competitive with platforms like MLS and bonds, but at the same time, it is for a long time a brokered market. I was kind of curious if you're seeing maybe look into the credit space for bonds or not. You guys do like private credit funds where some companies are issuing credit directly to LP as opposed to a public issued fund. What do you think?
So we, in 2017, we opened up a bond market, investment grade, and we've been trying to cultivate that. I think our first large issuer was Pepsi when they brought over their bonds. But I mean, at the end of the day, for exchanges, for any asset class, you know, if we can de-risk it, because again, our job is not to assume risk or assign risk. Our job is really to form a market where both sides get information transparency and so they can make their own decisions. If we can set that up in any type of market, we generally will move in that direction. So even though I don't have the stats, but you're great to call out, like, yeah, we moved in that direction because we saw it, right? Now, junk credit, on the other hand, that's something I don't know if we're really, I hope that we haven't, because then I'll just sound stupid. But, you know, I hope that we haven't gone in that direction, because there's the volatility in that in times of, you know, stress. And that's a little tough and people can get hurt. I think IG is a good thing. Now, in terms of the LPs versus funds, you know, I wish I had visibility into that. I don't. But that's a great question. Yeah. I think those are still, I know that there are automated systems for the vanilla ones, but like, you know, I still think it's a desk-driven type trade. Not to say that you wouldn't leverage like some sort of technology like Nasdaq to make the market, but I just don't think we're really stepping in there with like some automated quotation system to make that happen.
Well, we're coming up on the end of our time, but I got to ask, you know, what advice do you have for those in the room that are still interested in finance careers and thinking about different options, you know, opportunities at Nasdaq, opportunities in the Bay Area? What do you see?
Yeah, I wouldn't read the news. And that's not just to say because a lot of it is negative, but like it's a little self-serving as to what can catch the most eyeballs, and I think we all know that. But like, just case in point, like Goldman lays off 3,000, right? It wasn't by any irony that they also shuttered Marcus, which was a bad consumer bet, right? I don't know the proportion of the layoffs. I'm sure it cut across a lot of different things, but I bet you the majority were in Marcus. But the press makes it sound like it's this systemic thing across the entire bank. That's not necessarily the case because they just also had the largest partner class that they've ever had in 2022. Okay, so you know, you have to search for the news to find the signal outside of the noise. What I do know is that, well, at the same time that Meta and Google, let's focus on Meta first. They're pivoting a lot of investment from the metaverse, as a lot are, into AI. Okay, that is going to, just because they're laying off folks now, it's a recalibration to hiring in the future. Okay. Also, granted, you have Apple, Microsoft that look back in the times of stress, post-dot-com bubble, after 2008. They rolled up so many companies, right? They acquired so many companies in those intervening time periods. Bankers were busy. Wouldn't really know it, but they were. And that's, I think, the environment that we're actually moving into now. There's going to be a lot of companies either for cheap or for value, should be purchased. And people in finance, whether it's investment banking, private wealth, treasury, they're going to have a role to play in that, and they're going to need to staff up. But you're never going to read that in the press, period.
So some optimism.
Optimism. I'm Sunshine Dan.
Sunshine Dan.
Yeah.
Well, Sunshine Dan, it's been awesome having you here. That's cool. Thanks so much.